Hello, and welcome back to the 7th episode of the Growth Portfolio Update series. So, in today's episode, I wanted to go over big news for two companies in the portfolio, as well as updating you on how we're doing against the S&P 500. So, there were two big events for companies in my portfolio recently. One was the NVIDIA Stock split. Now, I wanted to kind of go over what a stock split is and how it can benefit a company and what it means for a company. So, stock splits in essence don't actually change the value of the underlying stock at all. It basically creates a multiple of more stocks so that the value of each stock is less, but the total value of the company remains the same. And in NVIDIA's case, that was a 10-for-1 stock split, which means every stock is worth exactly 1/10 the value it was before, but there are 10 times the number of stocks. The only thing this really does is just make it a little bit more easy for normal investors to buy into NVIDIA because it's a lower value. So if you wanted to buy a share, it would now be, instead of $1,000, now you're paying simply about $131 per share. Although this is not super relevant nowadays because there are so many different brokerages that allow you to buy fractional shares or that sort of thing, or you can buy an ETF that has NVIDIA in it, and that might have a much lower price as well. So it's not really as important as maybe it used to be, and I don't think it should be ever a good rationale for you to buy a stock, because it doesn't really change anything about the company itself. And even the argument that it makes the stock more accessible because it's a lower price is not as relevant today as it was 5-10 years ago when buying fractional shares wasn't really a thing. So that's what happened with NVIDIA, and that's why it sort of benefits the company, is it makes it a little bit more accessible, but it's mostly just a status thing. If a company has a stock split, it usually just means that the company is doing really well and the stock price has gone up quickly and it's gotten to a point where it's too high of a value to make sense as an individual stock. So they need to have it split up to bring it back down to a more reasonable price. And the second big event is CrowdStrike, my favorite cybersecurity company, is now included in the S&P 500. This is also, similarly to a stock split, is an event that is mostly a status symbol for stocks. It's not as important. It doesn't actually change the underlying value of the company. It doesn't make CrowdStrike a better company or anything. But I would argue that being included in the S&P 500 does actually have a real benefit. And I would say it's even a little bit more than stock splits. And the reason for that is, now that CrowdStrike is included in the S&P 500, it is eligible to be in ETFs and index funds that cover that track the S&P 500. So that means that every time someone is buying an S&P 500 ETF or index fund, they're also buying a small amount of CrowdStrike. And there are a lot of people who buy S&P 500 index funds and ETFs, myself included. I think most people, and even most institutions, have a lot of money in the S&P 500. So that means that there's going to be a lot more inflow into CrowdStrike, and that can benefit the company if they need to issue more shares. It kind of helps to create more volume and just increase the price of the shares, which helps the underlying company a little bit. In case they need to raise capital, they can sell some of their shares at probably higher prices, and they have more volume because they're now included in the S&P 500, which will create more people who own CrowdStrike shares. So I think that is actually a really good thing for the company. And I would argue it's slightly better than a stock split, but both are kind of similar, sort of mostly status symbols, but they do have some slight benefits for the companies themselves. And that is sort of my take on how stock splits work and how getting added to indexes like the S&P 500 work. I would argue that the S&P 500 is probably the best index to be added to. Like the Dow Jones used to be probably the biggest, most popular index, but I would say nowadays most people would invest in the S&P 500 and not the Dow Jones. The NASDAQ is also, it's a good index as well, but I would say the S&P 500 is, out of the three, the Dow, the NASDAQ, and the S&P, is definitely the most popular one. I think the NASDAQ might eventually become the most popular one. It seems like it does outperform the Dow Jones and the S&P 500 over like recent history, maybe the last 10 years. So maybe at a certain point the NASDAQ becomes an even more impressive index than the S&P 500. But for right now, S&P 500 is kind of the king of indices and the king of like ETFs and index funds. So that was the two big events for companies in my portfolio, and both of them have been doing amazingly. And that's the reason why these events occurred, is because of how good they've been doing in recent history. And it's also a very good thing for me because Schwab only lets me buy fractional shares of funds that are in the S&P 500. So I've been kind of stuck with these 5 CrowdStrike shares, even though I've been wanting to like slowly dollar cost average. It's just too expensive for me to want to throw like $300 into one share. So it becoming in the S&P 500 allows me to buy fractional shares through Schwab, which is going to be nice going forward, since I will actually be able to hopefully dollar cost average into CrowdStrike without putting tons of money in there all at once. And as you can see, the portfolio has grown to 45,000, just over 45,000. And now let's take a look at how we are doing against the S&P 500. So let's start off just by going and looking maybe back a month. Okay, so this is the past month against the S&P 500. You can see we're the individual in blue and the S&P 500 is the other one. And you can see that over this past month we have outperformed the S&P 500 quite handedly, about 7% versus 4.2%, and that looks pretty good. I'm curious how we look against the Dow. Yeah, the Dow actually went down this past month, so it's down about almost 2% at 1.91, and we are definitely breaking away from the Dow. It should be a lot closer for the NASDAQ. Oh wow, the NASDAQ actually beat us. This is a pretty close alignment in terms of like my portfolio versus the NASDAQ, but we did actually slightly lose. I feel like most of the time we slightly win against the NASDAQ, but this time the NASDAQ actually beats us. So that's interesting. Now I'm just going to take a look back further. We look at the max. This is the S&P 500 versus my portfolio for the past, it's been about almost 3 years. Probably just about 2 years. It's been a little over 2 years. And as you can see, we have broken away starting about here, and we are sort of maintaining our lead. I think we're not really stretching it too much. The S&P 500 is still performing really well, obviously, but we are maintaining the lead, I'd say. And I'd hope to be able to start stretching it. Hopefully, if this bull run kind of continues, we might do that. But for right now, I'm happy just being able to beat the S&P 500, and I hope we are able to continue that going forward. And I'll see you guys in the next one. Thank you for watching.